Hi, Carl. Good to be with you. Well, look, we talked about in mid-June about a big bear market rally to come that would kind of create a rebalancing effect of going into the key moving averages. We were too far disconnected, and this rally has really ticked a lot of boxes. The 208-day moving average on the S&P, the weekly 50-day moving average on the Russell, and then we got the rejection. And so now it's really interesting to see how this historically plays out, because we've seen these type of big bear market rallies before when optimism comes back, shorts cover, and then it all rolls over. And that's why what happens next in the next 4-6 weeks, I think, is absolutely key. Apple in particular has been incredibly impressive, leading everything along the way. It is the largest stock in the stock market, 7.5% of the S&P, 11% of the NASDAQ 100. So it has a major weighting. But the rally was very steep. It was very narrow, and it also hit a key trend line. So not a moving average per se, but a key resistance line, and rejected from there. So principally, I would say if Apple can get above that trend line and sustain that move, defend it, then it can go to new all-time highs as if nothing has happened, right? Because the stock was almost flat on the year. But if it cannot do that, then it risks, along with the macro monetary context that we're facing with tightening financial conditions, that this all rolls over still here this fall.
Right. That is an interesting question. I mean, given its status as a general and a safe haven and the buyback and the phone cycle, is all of that in aggregate, can it compete with the force of the Fed?
Well, see, here's the thing. I mean, we are in a very interesting place here with regards to the Fed. The rally in June was accentuated by two things. One is Chairman Powell actually being interpreted to be very dovish at the July press conference, and then the rollover inflation. So the market's been rallying on a rollover of inflation narrative, and with it came easing financial conditions, which is not what the Fed really wants to see if it's serious about fighting inflation. And ever since that meeting in July, the market has been ignoring every Fed speaker that's talking about restrictive financial conditions. And here's the inconvenient truth. There's no history, none, where the Fed can beat in structural inflation with financial conditions not being restrictive. And they're not restrictive yet. Now, several Fed presidents have come out and said they need to go restrictive. And that's kind of the credibility issue, because the market doesn't seem to really believe them at the moment. And the other issue, the other inconvenient truth, the only way to really beat inflation historically, 70s and 80s, is with a recession. And then the structural market bottom, in terms of history, does not come until the Fed is already deep in a rate cutting cycle. And that's because, obviously, then earnings estimates come down dramatically during the recession. And we're not at that point yet. We're not even in the restrictive territory yet.
Yeah. But it seems like a lot of folks wouldn't mind a little baby recession at this point, though. It seems like, you know, even if the landing isn't exactly soft, a little baby recession might not be so bad. But back to Apple for a moment. What in this market does Apple represent? I get the sense that sometimes there are certain types of companies that act as champions for certain points of view, or maybe tell you something about the way the market might move. What kind of company is Apple? What does it represent for the market that has been performing so well? And so what can we read into it based on how it performs in the next quarter or so?
Well, it is the safe haven. I think they, as the largest stock, and obviously attracts a lot of index fund investing, and obviously from that perspective has that massive $90 billion buyback program that supports obviously the price movement as well. But then also very successful. They were, amid all the supply chain issues, they were able to get their launch date in order for September 7th for iPhone 14, and so obviously people are looking forward to an upgrade cycle there. The question is how tough or how convicted will the consumer be, because consumers are struggling. You know, real wages have been negative for the last year and a half, and inflation, while it may be rolling over, this is not going back to 2% in a few months. This is going to take a couple of years. So the pressures remain big time.
Hey, finally, Sven, both Morgan Stanley and JP Morgan last 24 hours have had cautionary notes, not so much about the pace of rates, but the force of QT when that hits its full force in the coming months. Do you see real liabilities for equities as a result of that?
Absolutely. Look, the monetary base, well, QT has not officially gone yet in full gear, which it will do in September. The monetary base has actually been shrinking. And all year, and last year we saw this incredible correlation between the directional flow of the monetary base and the S&P. And this year, every time we had a big drop in the monetary base, the S&P dropped, and when there was a slight uptick in the monetary base, we had these big rallies. So you have to ask yourself, even if rate hikes slow or even pause, with QT coming into full effect, what is the directional flow of the monetary base going into next year? And based on what the Fed is doing, the expectation would be lower, and that would represent a headwind for equities for sure.
That's going to make it a little more complicated in the next several weeks, Sven. Great stuff on Apple, on the Fed, on QT. We'll talk soon. Sven Henrich.
Thanks, Carl.